Hey everyone, welcome back to Corporate Decoder. Today, AEAEW just filed an 8, and I am seeing a common SPAC move that traders need to know about. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing is all about a company extending its deadline to find a merger partner, a move often seen in the SPAC world. So, AltEnergy Acquisition Corp, which trades under the ticker symbols AEAE for units, AEAE for common stock, and AEAE for warrants, has filed a document detailing a special meeting of its stockholders. The main event here is the decision to extend the company's deadline to complete a business combination. The report is dated the 27th of April 2026, and it tells us that on this day, AltEnergy Acquisition Corp held a special meeting. For context, companies like this, often called SPACs, or Special Purpose Acquisition Companies, are created with the sole purpose of raising money through an initial public offering to acquire an existing private company. They have a limited time to do this. AltEnergy Acquisition Corp is a Delaware corporation. As of the 20th of March 2026, they had a little over 6.2 million shares of common stock outstanding. This included both Class A and Class B shares. The important part is that about 91.8% of all outstanding shares were present at this meeting, which means there was enough shareholder participation for them to make decisions. The big news from this meeting is the approval of Proposal 1. This was a proposal to change the company's founding documents. Specifically, they wanted to extend the deadline to either find a company to merge with, or, if they can't find one, to wind down their operations and return money to shareholders. The original deadline was May 1, 2026, and they have now extended it all the way to May 3, 2027. This gives them about an extra year to find a deal. This kind of extension is very common for SPACs when they are having trouble finding the right merger target or if market conditions are challenging. It is like buying more time to get the job done. Looking at the voting results for this extension proposal, an overwhelming majority voted in favour. There were 5,750,010 votes for the extension and 0 votes against or abstain. This shows strong support from the shareholders who voted to give the company more time. Now, here is where it gets interesting for investors. When a SPAC extends its deadline, shareholders often have the option to get their money back. This is called redemption. In this case, 2719 Class A shares were redeemed. This means those shareholders decided they did not want to wait any longer and took their portion of the money from the company's trust account. This redemption means that about $32,970 was taken out of the company's trust account. That works out to roughly $12.13 per S-share. This is a small number of redemptions in the grand scheme of things, but it is important because every dollar redeemed is $1 less that the company has for a future merger or to operate with. To make this extension official, the company filed an amendment to its Certificate of Incorporation with the state of Delaware on the 29th of April 2026. This is basically the legal paperwork to formalize the decisions made at the shareholder meeting. The actual document detailing these changes, the Fourth Amendment to the amended and restated Certificate of Incorporation, is attached as Exhibit 3.1 to this filing. It contains the precise legal language about the extension. When SPACs like AltEnergy Acquisition Corp extend their deadlines, it is a mixed bag. On one hand, it shows that the management team is committed to finding a deal, and that shareholders are largely willing to give them more time. This can be a positive sign, especially if you believe in the SPAC strategy. However, frequent extensions can also signal that the SPAC is struggling to find suitable merger targets, which could lead to a higher number of redemptions. Redemptions drain the trust account, leaving less capital for the combined company post-merger. Historically, many SPACs that go through multiple extensions and significant redemptions don't end up performing well after their merger. For instance, in the boom years of SPACs, companies that extended frequently often saw their stock prices decline substantially after merging with a target. It is a sign of the SPAC struggling to deploy its capital effectively in a timely manner. The risk I am watching is how much more capital will be redeemed before they find a deal. What I'm actually looking for is a strong merger announcement that justifies the extended runway. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives. Check out the Discord in description.